A big bank just raised its price targets on all group chippings. The headline reads like a green light, but the target is forecast, not fact. Here's how to actually read an Analyst upgrade. In 2026, Citi raised its price targets on a basket of memory and chip equipment names, the companies that make the chips and the machines that make them. The headlines turned it into one word: bullish. And the instinct is immediate. A famous desk got more optimistic, so the stocks must go up. But many treat an upgrade as a green light. The reality is that a price target isn't a promise about the future. It's a forecast, only as good as the assumptions baked into it. So before you react to Citi's call, what should you actually be asking? Not whether they're bullish, but how a target like this gets built in the first place. Here is the machinery behind that number. An analyst builds a model. They estimate how much a company will earn next year, then multiply that by a multiple, the price investors will pay for each dollar of earnings. Earnings times multiple gives the target. So when a desk raises a target, only two things can be happening. Either they expect the company to earn more, or they think investors will pay a richer multiple for the same earnings. Or both. A higher target is never magic. It's one of those two dials being turned. And the most useful number to pull from any upgrade is the gap. The distance between today's price and the new target. That gap is the implied move. Now here's the part that flips the intuition. People hear a higher target and feel reassured, but a higher target actually makes the company's job harder, not easier. Why? Because raising the target usually means the desk raised its earnings forecast too. Expectations are now set higher, so the company has to clear a taller bar to justify the new number. This is exactly how a stock can post a strong quarter and still fall the next day. A pattern traders have called selling the news since the 1980s. It beat last year, but missed the raised bar. An upgrade isn't a gift handed to the stock. It's a higher hurdle planted in front of it. And one upgrade is just one vote. Citi is a single desk with a single model and a single set of assumptions. Another bank can run the same numbers and land somewhere completely different. The dot-com run-up of 1999 was full of glowing targets that aged badly. So how should you weigh it? 3 questions cut through the noise. First, what changed? Earnings, the multiple, or both? And does it hold up? Second, where does this target sit versus everyone else's? High, low, or consensus? And third, what is the stock's price already doing? The tape is its own evidence. A price that ignored the upgrade may have priced the news in already. No single desk owns the truth. So go back to where we started. Citi raising its price targets on those chip names in 2026. The lesson was never about the chips. It's the reading. A price target is a forecast. Earnings times a multiple. So the first move is to find the gap between today's price and the target, because that gap is the implied move. Then remember, a higher target raises the bar the company must clear, which is why a strong report can still disappoint. And finally, treat the call as one vote. Weigh it against other desks and the tape. It's a framework, not advice. Verify the numbers yourself. Citi's price target is a hypothesis. A higher target raises the bar to beat.